What's up, you guys? It's Graham here. So this changes everything. I know this might be hard to hear, but there's a growing realization that the stock market's not going higher. It's just the dollar getting weaker. And when you look at the numbers, they're not exactly wrong. For instance, despite record high market growth, you would actually be negative for the year when you account for how much the dollar is quickly losing its value. International stocks have now outperformed the S&P 500 by the widest margin since 1999. And if this trend continues, you're either going to wind up really rich or really broke, all depending on what you do next. That's why we gotta break down exactly what's going on, if there's any truth that the dollar's losing so much value that it now costs that much more to buy stocks and real estate, and then what you could realistically do to come out ahead financially, because now is not the time that you want to get left behind. Although before we start, if you find videos like this helpful, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. It helps out tremendously. This video took me almost a week to put together, and as a thank you for doing that, as promised, here's a picture of a corgi. So thanks so much, and also a big thank you to Policy Genius for sponsoring this video, but more on that later. Alright, so before we talk about what's happening with the stock market, let's discuss where all of this begins, the declining US dollar. Now, even though this might sound like a sensationalized headline, I think we could all agree on one thing. Your money is going to be worth significantly less 20 years from now than it is today. And if you want to see just how bad it's become, check this out. Back in 1913, the value of $1 had the same purchasing power as $100 has today. And over time, your money just falls further and further behind. Like if you just had $1 and held it for 100 years under a mattress, it would buy you the same amount today as a penny does. Essentially, even though the US dollar is seen as the world's reserve currency, there are currently 3 factors causing it to fall very quickly, with the first being money printing. Essentially, imagine our economy like a giant pizza. If you have 10 people and cut the pizza into 10 slices, each person has the rights to an equal slice. But what happens if the government comes in and cuts that pizza into 20 slices? Well, now all of a sudden, each person has half of what they did before. But then what happens if the government comes in and says, yeah, so we're actually going to cut that pizza into 10,000 slices, and your small little crumb might get cut even further if we need to divide it up even more. Well, that's basically what's going on with the dollar. And it's getting a lot worse. In this case, our national debt has recently surpassed $37 trillion, and we're now at the point of no return, because as government debt gets bigger, investors' concerns increase that their money will eventually get devalued, causing them to demand higher interest rates, causing the government to have to issue more debt, causing investors to demand even higher interest rates. Basically, there's no way out of it, other than printing more money and devaluing the currency even further during a time where fewer investors are buying it. Now, 2, we have political instability. The fact is, right now, fewer countries are buying US debt because they're worried about the long-term health of the dollar, partly due to government debt, but also partly due to tariffs. In this case, the head researcher of Deutsche Bank said that the damage has been done. The market is reassessing the structural attractiveness of the dollar as the world's reserve currency and is undergoing a process of rapid de-dollarization. And to take this point even further, recent surveys found that 70% said that they no longer want to invest in the dollar due to growing geopolitical risks, up from 31% a year ago. And third, money is going elsewhere. For example, since the US has abandoned the gold standard, the dollar's lost over 85% of its purchasing power, while gold prices have increased 85 times. And it's also highly liquid, lagging only the stock market. On top of that, Bitcoin is also gaining dominance, and when other options are available, less money flows into the US dollar, causing it to fall even further. Even JP Morgan called for a dollar reset, saying that the dollar's long-standing overvaluation is beginning to unwind, which could result in a 10 to 20% decline against major peers, such as the euro and Japanese yen, over the median term. We don't see this as a breakdown in the dollar, but it is a reset. Really, at the core, there's just no way to sugarcoat it. Our debt is continuing to grow. Our dollar continues to get printed into oblivion, and eventually it becomes unsustainable. Now sure, the government could make an effort to reduce their spending, increase tax revenues, and make an effort to pay it down, but the more time goes on, the less likely it appears to be the case. And that leads us to our next topic, the stock market. See, here's the thing. When most investors think of the stock market, they envision something like the S&P 500 or the NASDAQ, which encompasses the largest US-based companies like Apple, Amazon, Facebook, Tesla, and so on. And historically, they would be right to assume that these usually have the highest returns. Except they don't always. In this case, for the first time in more than 2 decades, international stocks have started outperforming the United States by more than 12%. And as you can see, throughout the last 50 years, there are repeatable cycles where the US begins to lag behind. of which some argue that we are due for a total market reversal. After all, the current price-to-earnings ratio is currently at a level that usually precedes a drop. Vanguard now predicts lower than usual returns over the next 30 years, and international markets, in comparison, might have more room to grow. Of course, holding on to cash still performs way worse than just investing your money, but the point still remains. If you don't invest in something, you will lose a significant amount in the long run. So in terms of what you could do about this and the impact this is about to have on the entire market, here's what you came for. Although before we go into that, while we're on the topic of investing, as I'm sure you've seen, anything can happen, and sometimes you have to prepare for the unexpected. Like, even though you should always track your expenses, cut back when necessary, and invest consistently, it's also as equally important to make sure your loved ones are taken care of financially in the event that something were to happen to you. And that is where our sponsor, Policy Genius, is there to help. For those unaware, Policy Genius makes it incredibly easy to compare life insurance quotes from America's top insurers in one place with a few clicks to find your lowest price. In fact, with Policy Genius, you could find life insurance policies starting at just $276 a year for $1 million in coverage. It's an easy way to protect the people you love and feel good about the future, with thousands of 5-star reviews on both Google and Trustpilot. Plus, for those that don't even know where to start, their team of licensed, award-winning agents will walk you through the entire process step by step, answer any questions you have, and help you make decisions with confidence. Not to mention, since they work for you and not the insurance company, they don't have any incentive to recommend one insurer over the other. This is especially important because life insurance is not a one-size-fits-all product, so Policy Genius doesn't treat it like one. They lay out all of your options clearly, from coverage amounts, prices, and terms, leaving you with no guesswork, just clarity. So check life insurance off your to-do list in no time with Policy Genius. Just head to policygenius.com/Graham or use the link in the description to get your free life insurance quotes from top companies and see how much you could save. Again, the link is down below to get started today. Thank you so much, and now let's get back to the video. Alright, now here's the part you came for. Is a declining dollar actually causing the stock market to go higher? After all, the stock market recently hit a brand new record at the same time that the dollar fell to its weakest level in roughly 3.5 years. So they have to be connected, right? Wrong. Didn't expect me to say that, did you? So here's the thing. When you look at the dollar's value throughout the last 50 years, you'll notice some pretty wild swings. Like, it depreciated from 2002 to 12, and then it appreciated through the 2010s, all during a time where the markets went up and down and back up again, effectively showing no correlation between the two whatsoever. Fisher Investments also analyzed this phenomenon going all the way back to the 1970s when the dollar was taken off the gold standard. And wouldn't you know it, they found that the correlation between the trade-weighted dollar index and the S&P 500 returns is only about 0.15, which is essentially zero. On top of that, they also found that global stocks were up 76% of the time, whether the dollar was rising or falling. Of course, that's not to say that the dollar can't have some impact on the stock market short term, although all of the data says that the dollar's movements do not have any reliable indicator of whether the stock market goes up or down. But what about inflation? Surely that has to impact the stock market, right? Well, to a certain degree, yes, inflation can be factored into the price that you pay for stocks. But when you really begin to nail down the data, it appears as though there is no direct correlation between more money printing into the economy and higher stock market prices. Like, as Ben Carlson from A Wealth of Common Sense blog points out, this could be because the stock market is supposed to be forward-looking and inflation involves backward-looking data. But even if you did some sort of look ahead, there's nothing there. This all suggests that the stock market is genuinely expanding. It's actually boosting purchasing power, and it's fueled by good earnings and liquidity, not necessarily excess money printing. Now sure, some people could argue that more money printed gives people more purchasing power, which helps boost companies' profits and helps boost stock prices. But it's not the money printing itself that's causing the stock market to go higher, if that makes sense. So what's really impacting the value of the dollar, and in turn, the value of the entire stock market? Well, in terms of the US dollar, I hate to say it, but that answer is pretty simple. Tariffs. Overall, geopolitical risks have the largest effect on the US dollar, above and beyond anything else. Why? Well, when you have global uncertainty, like upcoming tariffs, companies delay spending, hiring slows down, and consumers pay higher import prices, which all tends to slow growth. On top of that, purely from a monetary standpoint, it also didn't help that the US put strict sanctions on certain countries, causing them to find alternatives. And without going into whether or not this is right or wrong, in the long run, let's face it, it worries other nations that if they're holding on to US dollars and they do something the US doesn't like, All of their money could essentially be taken away or frozen, which is not something that helps the world's reserve currency. So in terms of where we could go from here, many analysts expect this trend to continue throughout 2026, especially as the Fed lowers interest rates, thereby making US Treasuries that much less enticing to buy. So here's how you could protect your money. 1. Don't hold on to too much cash for too long. Now that's not to say that you shouldn't have an emergency fund or some money on the sidelines while you save up for a big purchase, but it is to suggest that you probably shouldn't stay out of the market for many years in a row. Otherwise, you're likely going to lose purchasing power. 2. You should diversify your investments throughout as many different sectors as possible. The more you spread out your money, the more you reduce your risk and volatility. That way, should one market fall, the others should more than make up for it. 3. Ignore the negative news and keep buying it. Study after study shows that the best thing you could do is stick with your plan, keep buying into the markets, and hold without panic selling. Like just even missing the top 10 best days in the market in a 30-year period will lower your returns by half. 4. Keep a steady income. I've said this before, but the biggest risk I see is that a drop in the stock market is usually correlated with job losses and a reduction of income. This is why it's so important that you do your best to keep a consistent income, to keep buying into the markets, or at least pay your overhead expenses so that you don't have to dip into investments. 5. It's probably a good idea to stay at a margin and debt. I think it's pretty safe to say that you're playing with fire anytime you borrow money for the sake of investing, so it's probably not worth it. Don't do it. And finally, 6, if you need money over the next 2 to 3 years, it's probably not a good idea to go and invest it. A few years is just not long enough to ensure that you're actually going to make money. And as you've seen throughout history, there have sometimes been decades where the stock market doesn't recover. So the shorter your investment time frame is, the less likely that money should be in the markets. At the end of the day, all of this is just about protecting your assets and making sure it grows long term without losing value. So in terms of what I think about this and what I'm doing with my own money, I'm going to be honest, I do have serious concerns about the value of the US dollar in the long run, but I also don't expect it to collapse anytime soon. Like, the reality is, it's still the reserve currency of the world. It's still predominantly used throughout global trade, and I don't expect this to stop anytime soon. However, we cannot deny the government spending is out of control, and there are so many alternatives now to the dollar that are gaining a lot of attention, like gold, Bitcoin, and other world currencies. For this reason, I do not think it's worth it to completely restructure your entire investing philosophy over a concept that could take decades to play out, but I do think it's worth it to think strategically about what you're doing and hedge yourself so that no matter what happens, you're going to be okay. This is why I still keep a portion of my money in US Treasuries, earning 4.2%, and I continue to buy into the markets on a daily basis, split evenly between 1/3 US stocks, 1/3 international, and 1/3 into a Bitcoin ETF with money I don't intend on touching for another 20 years. This is also in addition to the real estate I already own with fixed-rate mortgages between 2.8 to 3.4%. All of this is a hedge against a falling dollar, and long-term, I'm still very optimistic about the markets. Like, here's a fun fact by Ryan Detrick on Twitter. The S&P 500 has been higher in a post-election year 9 of the past 10 cycles, going back 40 years. Of course, I could also be totally wrong, but I'm in the mindset that it's worth it to hear out as many different perspectives as possible, hear out the experts who seem to know what they're talking about, keep an